We experienced technical difficulties during our live broadcast, so this is a rebroadcast. Healthy bull markets climb a proverbial wall of worry, and we certainly have plenty of those. The COVID pandemic leads the list. 8 vaccines are currently in large, late-stage clinical trials around the world. Historically, it has taken about 10 years to develop an effective vaccine. Expectations are for 1 or more to be widely available by spring, which leaves the winter months ahead as the next big COVID wave gets underway. According to former FDA Commissioner Dr. Gottlieb, we're probably in the 7th inning of the acute phase of this pandemic right now, but the hardest part is probably ahead. COVID's obviously had a significant economic impact. During the second quarter, on an annualized basis, U.S. GDP contracted 31.4%. This past quarter, it's expected that U.S. GDP on an annualized basis will have recovered 35.3%. On a global level, 2020 is expected to be a minus 4.9% global growth, so pretty significant decline in economic activity across the world. In 2021, the expectation is for there to be a 5.4% GDP growth, so pretty significant recovery back to probably pre-COVID levels. So sort of simultaneously, COVID's economic impact has been brutal and much better than many of us expected if you think back several months to where we were. The big news today, of course, is the upcoming U.S. elections in 2 weeks. We'll have an election. Won't be 2 weeks when we have an outcome. It'll probably be quite a bit longer than that with the, all the ballots that are being cast either through mail or ahead of time. Biden's, according to the polls, leading, but so was Hillary Clinton 4 years ago. Market expects a Biden win, but another Trump victory would not be a shock given that it would be the second time. And certainly, I don't think we should expect the same sort of market responses we saw 4 years ago in the overnight trading. Senate control is considered a toss-up. There's been economic analysis conducted on, both the Senate staying Republican and the Senate flipping Democrat. There's nothing troubling in either of those economic analyses. So, overall, I think that that'll be a fairly neutral variable in terms of what we can expect from an investment standpoint. However, top earners, the ones making $1 million or more per year, are going to likely experience an enormous tax hike if Biden wins and the Senate flips. And Adam's going to address that a little bit later. Regardless of the outcome, there almost certainly will be court battles, likely ending at the Supreme Court, and we could experience unprecedented social unrest. As either way this turns out, there's going to be an extremely unhappy 40% of America. I'm going to flip over to process improvements, sort of internal to Burney, and thinking back over my 35 years here, we've probably made 1 to 2 significant process improvements each decade. Many were internal to our analytical processes, but several were external, involving either newly available technology or analytics. We've just made a major financial commitment to one of these process improvements, and Andy's going to cover that also a little bit later. So with that, I'll turn it over to Adam.
Thanks, Lowell. And we're going to start by looking at broad market returns for the quarter, like we do every quarter. And so after an extremely volatile Q1 and a record-breaking second quarter, stocks globally posted somewhere between the mid to high single-digit returns for Q3, depending on where you're looking. And this is despite a 10% correction that we experienced in domestic markets from September 2nd to the 23rd of September, when concerns around high valuations for tech stocks in the upcoming election began to garner more attention. And we consider that correction to be a healthy one in the context of the sharp rally that we saw from the March 23rd bottom of the market. Somewhat unrelated to things more broadly, but very related to tech stocks, is the thing that we continue to keep an eye on is the current level of concentration within the U.S. stock market, meaning a small number of companies are having a more significant amount of influence on overall market movements. And currently, the top 5 stocks in the S&P 500 make up just over 23% of the index, which is the highest percentage we've seen since the early 1970s, when companies at that time like Disney, IBM, McDonald's, and Xerox were seen as the big players of the market. What followed and preceded that period of time was a very sharp rotation out of large growth and the beginning of a small cap and a value space that lasted through the early 80s. So part of what we're looking at just in terms of the market in general and the valuation gap between large and small and value and growth is that opportunity in small and value, and that translates to our positioning right now across our portfolios. So that's the opportunity area to take from the market movements of the past year. The bond markets remained relatively flat after posting, low single-digit returns in Q2. We saw a pretty flat Q3 as things are range-bound from an interest rate standpoint. Rates are staying in a low and tight range in anticipation of rates being held low for longer. And this is in contrast to Q1, when we saw a pretty strong rally in the bond market as a result of concerns around the COVID outbreak initially and the sharp sell-off in stocks. So pretty unexciting year for the bond market despite what we've seen in stocks. So let's move on and look at some of the asset allocation trends that we're seeing over a longer term window of time. If you look at the past 1, 5, and 10 years, you'll notice a couple trends. Number one, because rates have continued to decline and stay low, you've seen a bond market that's been pretty consistent. You've seen a pretty persistent return gap between domestic and international equities, and that's something that's very cyclical. Just like large versus small cap companies and value versus growth companies, the trade-off of domestic versus overseas stocks takes a very similar pattern over time, where you'll have periods of underperformance, under or overperformance of one versus another. So that's been very clear since, you go back the last 10 years, since the bottom of the financial crisis. So that's something we've looked at. The other thing that's also, apparent overall, but not necessarily on this slide, is, some of the sub-returns that we've seen across these categories. For instance, over the last 12 months, you've seen a 55% return difference between large growth and small value. So while a lot of the attention gets put on the overall market and the broader indices, you do see trends on the smaller scale that play out and become very important to monitor and adjust for where needed. When we look at the economy and the economic backdrop behind this overall market rally, it's been a lot of the same story. We've got continued liquidity from central banks. We've got slow but very sustained progress on economic reopenings around the world. And as we slide forward, you'll see some of the headlines. Some of the major economies, such as the U.S., they're still in a very early stage of the recovery with uneven progress. So the next stage of economic momentum we're going to be looking at and looking for is really going to be dependent on the path of COVID-19 and also additional policy support. So will Nancy Pelosi and the White House come to some sort of an agreement on the next fiscal stimulus bill? That seems to be where a lot of the attention is going right now, with parties on both sides, threatening to wait till after the election. A no-deal scenario is something that's a possibility and something that could impact the markets, but I think the markets are fairly aware of that at this point with all the rhetoric. So past that, even if we get another stimulus bill and the election is resolved, we're still going to have to climb our way out of one of the shortest and most severe recessions we've had over the past century. And because of the severity of the recession and the fact that we don't have a more permanent solution to the virus just yet, the recovery is likely to continue to be gradual. And if you look here at some of the headlines that we saw over Q3, tell some of the story, but the main story here is that it's probably going to take us quite some time to get back towards that 2019 peak in terms of economic output. So slow and steady growth remains the base case for now until things change. Quick note on inflation, because we've got some questions around that from clients. We've obviously have not been worried about inflation recently, more so, low inflation or even deflation in severe cases. But between, a collapse in oil prices, a significant decline in output because of COVID restrictions, on top of already low inflation, we've kind of seen the stagnation of a well below 2% inflation rate. But with the amount of money that's been printed and the stimulus that we've seen and the money flowing into the economy and output picking back up, people are worried about inflation becoming a concern and a consideration. For what it's worth, the Congressional Budget Office, even with all of this in mind, is projecting headline inflation to remain below 3% throughout most of the 2020s. A lot of that is bolstered by the Fed continuing to voice a commitment and support to keeping rates low until the economy is back to full health. So the way we see it is, within the next few years, if the Fed has to raise rates aggressively to combat inflation and Congress has to cut budget deficits to fight against that, then the story behind that is we've got the economy back up and running to full health. So in terms of prioritization and what's important, we would see that as being a net positive overall, getting the economy back up to a more normal growth rate and getting the virus in check and handling the inflation piece of it later. So as we slide forward and we start to talk about the election, last webinar, we spent some considerable time reviewing historical context to election returns. And I'll repeat some of those things that we reviewed previously, but also touch on some additional points as we head into the home stretch, which is November 3rd. And I'm going to frame this and present this in three ways. And first will be a historical market performance context over full terms of past administration. That's number one. Number two will be what happened historically in the short term once election results have been revealed. And then lastly, it's that case of, what if this time plays out much differently than anything we've ever seen before, and we've got a contested election outcome that drags out for a considerable period of time, as Lowell stated. So the first and easy point is that you can't draw a identifiable pattern between the party in power and the returns of the stock market. Markets have historically posted positive returns and been very resilient despite the political and economic backdrop of a presidency. It's nearly impossible to correlate market returns specifically to politics. There's just simply too many variables that are going to impact market returns. And many of these policies that are implemented by administrations, they take time, and they take time to flow into the economy and create some sort of a lasting impact on corporate performance. So even if markets do post strong returns during the term of an administration, the question is, how do we know that's a direct result of the actions of the president? Sure, president can do things like adjust tax policy and regulation, but what about commodity prices, the actions of other global leaders, surprise events such as terrorist attacks and natural disasters, actions taken by individual companies, and lastly, investor behavior. There's thousands of variables that can play into stock price movements, and markets have been resilient despite politics. Lastly, I've gotten a couple questions from clients about, hey, I get it, the overall market does fairly well regardless of who's in office, but how about sector returns? We can apply the same logic that we do at the market level to the sector level. And some recent examples would be under President Obama, defense and the sin stocks, which were widely expected to suffer under President Obama, actually posted very strong performance in some cases. For example, you had the defense sector, which outperformed the S&P by over 400%. When going into the Obama presidency, it was all the talk was about a significant cut in defense spending. And then you had tobacco companies, which were supposed to be under fire, outperformed the S&P by over 250%. And then more recently, with the Trump administration, you had an expectation that the energy sector would be bolstered and really supported by the Trump policies. But you've actually had energy stocks be, the worst performing sector in the S&P since he's taken office. So promises and proposals are made on the campaign trail, and they help us get an indication of what the candidate's intentions are. But there's a lot of things that get in the way of a president implementing his agenda. And so it becomes a guessing game at the market and the sector level. And so if we move on to the next slide, we'll talk about, more specifically and statistically, how has this relationship between the market and presidential terms persisted over time, and what's the actual relationship been? And here we've got at the top broken out by Democratic and Republican president, and also various levels of congressional power. We're trying to rank or chart here the relationship between the president and what happens in the market. So if something is indicated as a 1 on the correlation spectrum, it's expected that there is a very strong result between the two, or a strong relationship between the two variables. And if it's 0, it is known that there is a weak relationship between the two variables. So as you see down below, we're looking across whether it's Republican president, divided Congress, Democratic president, Republican Congress. Any way you slice it, you notice a weak relationship between the market returns and the political environment and structure. So that handles the broad market piece of things, and we'll go on to point 2 here, which is, what happens in the short term? Hey, I get it, markets are resilient broadly and over time, but how about in the interim after election results are revealed? And so here we go back to the 1980s, and this table is going to look at what happens the day after and in a couple of months after a presidential winner is revealed. And you're going to notice nothing particularly interesting or exciting or standout-ish about this information. We've had all kinds of worries about each of these winners along the way. The Trump critics would have said he never held political office and he doesn't speak or act in the way that's presidential. Bill Clinton's critics would have said he was governor of a small state and unproven on a national scale, and that his tax hikes would crater the economy. And then critics of Ronald Reagan would have said he's just a former actor that lacks experience to be president, and his rhetoric towards the Soviet Union could potentially lead us to a nuclear war. So, and we can pick any of these presidents. There's a running list of pros and cons, but the markets and economy have survived all of these worries and more. So now that we've worked through the longer term historical returns of the market versus president, the short term of the same thing, we move on to the third piece of this, which is, let's say we throw all of this out the window and at this time it's going to be incredibly different than anything we've seen before, which is possible. As Lowell said, the idea that these times are different and we're going to have a post-election dispute and a environment of disruption and unrest like we haven't seen yet is something that we would be foolish to discount as a scenario to consider. But we're going to pose some questions. If this is what happens or what we expect to happen, how might we want to act or position ourselves, or what might we want to think about leading up to this type of event? So I'll start with number 1, which is, well, the markets might react negatively to this scenario. My question is it already priced in as a possibility? We don't know, just like we didn't expect a sharp recovery from the March 23rd bottom of the COVID sell-off. That was probably the most recent pronounced example of a disjointment of the headlines in the markets. Are they going to react the way we expect them to, and is it priced in? And if it does react, what's the severity of that reaction going to be? Is it going to be a 10% sell-off, a 20% sell-off? Guess your number. That's the second piece of the guessing game. The third is, when would they recover? When would markets bounce back after a sell-off driven by this, this scenario playing out? Would it be when the new president's finally announced? And if that's the case, how will the market react to either Trump or Biden winning? And if your preferred candidate loses, would you continue to stay on the sidelines or be a nervous investor, or would you bite the bullet and get back in? And the last scenario or possibility in terms of market reaction to something like this happening would be, what if the markets just completely ignore this and move forward, with their main focus being the virus and the reopening of the economy? So even if we go down that rabbit hole and try to play through all the possibilities, what if the market just completely ignores it, which we've seen time and time again? So the point really here being, is that when we observe these long-term stock returns, we focus on that attractive long-term average return. And that average return includes a number of meaningful recessions, market sell-offs, all riddled with uncertainty along the way. So unfortunately, the periods where markets rally when we think they should be tanking, that's where a lot of those gains are realized. So despite the possibility of things getting ugly in the short term, we're advising everyone to not to try and make any market guesses or take investment action based on that. So with market context in mind and those scenarios on the table, let's just quickly look at something that might be actionable for clients and something we want to consider for planning purposes, which is, let's say there is a change in administration. What can we expect? And one of the things that we can expect with any change in political power is always something related to a type of tax reform. So although it's still early in the game and a lot of things can happen, and some of these things may or may not be implemented, we just wanted to bring to your attention some things that we're seeing and hearing as key elements of the Biden tax plan. The first is a pledge not to increase tax rates on those making less than $400,000 a year. The second is that income above $400,000 would be subject potentially to additional Social Security payroll taxes. Right now, that's capped at a much lower number, well below $200,000. And the idea is that once you hit that $400,000 threshold and up, you would pay additional Social Security taxes. The third point here is a potential capping of itemized deductions at 28% of value. So despite what your tax rate is, even if you're let's say the new highest tax rate is 39.6%, your itemized deductions could be potentially capped at 28%. So that's something that's has been proposed in the past and is something to look out for. Fourth point being that taxes on capital gains and dividends would potentially be at the ordinary income rate for taxpayers with incomes above $1 million. Next would be a potential taxing of unrealized capital gains at death. Now we've got that very favorable step up in basis that occurs when you transfer securities down to future generations or a spouse. And there might be some numbers and thresholds attached to this, but there is talk of the fact that taxes on cap gains would have to be paid at death, whether or not those securities are sold. And then lastly is potentially a long list of new and expanded tax credits to target the middle class and other sectors that Biden would want to throw his support around. So this is something that will evolve. It's dependent upon the outcome of the election, but we're confident that there will be actionable items and planning conversations to have between you and your advisor, regardless of what happens. And these are things we want to try and take control of where we can. So with that, I'll pass it over to Andy to focus more specifically on our investment strategies.
All right, thank you, Adam. And you're right, it is time to focus a little more specifically on our investment strategies that we run here. In the last few webinars, we've spent quite a bit of time talking about the size and style responsive strategy. But that is not the only strategy we run, with the other one being what we call the master portfolio. The reason we spend so much time on SSR is because it's the strategy that sees the most change. But that doesn't mean the master is any less important. After the last few webinars, we did receive feedback from clients looking to hear more information about the master portfolio. And so we wanted to take some time in today's presentation to compare and contrast the two strategies, to highlight the differences and point out what each strategy is attempting to accomplish. The master has the longest track record, going back all the way to 1974 when this firm was founded. It's the strategy that our founder, Jack Burney, developed himself. And the whole premise is to find companies that are a good value, but also have good growth opportunities. We used to think of this portfolio as a true value portfolio or a true value strategy. But really, as we've analyzed it more, it's more of a growth at a reasonable price approach. This contrasts to a deep value strategy that looks for extremely undervalued companies, kind of regardless of fundamentals. But the master is looking for companies that, while cheap, also show attractive growth rates and profitability. That being said, we do still consider it a value biased strategy because there are pretty strict screens, specifically the price to earnings ratio screen that's historically been around 17, that keeps it tilted towards value. And in fact, it's this value tilt that is how the size and style responsive strategy was born. Value really struggled in the late 90s as the dot-com bubble grew, and we were looking for explanations for why we were underperforming and how to fix it. About during the same time, a few years earlier, there was research coming out from academics showing that size and style, so large caps versus small caps, or growth stocks versus value stocks, were the dominant variables impacting stock market returns. And what we found is, better yet, size and style moved in phases. So there were times when value outperformed, but there were also long periods of times when growth outperformed. And the cycles were long enough that you were able to tilt portfolios to take advantage of the size and style phase. And if we had been running this strategy during the 90s, we likely would have tilted towards growth and seen less underperformance during that time frame. So the question that comes up from this, given that Master is the longest portfolio and given that size and style is a little bit newer, is one strategy better than the other? And our answer there is no, but you do have to understand the differences. There really isn't any one best way to invest. There are lots of strategies that can have success, and really the key is sticking with that strategy. And SSR versus Master really shows how you can take different strategies and still create sound portfolios. The first part that I want to highlight is the concept of portfolio construction. So in finance, there's a jargon term about portfolio construction where you can either build a portfolio with a bottom-up approach or a top-down approach. And really all that means is the bottom-up approach looks at the set of all investable securities, does some screens on them, and then builds the portfolio up from that set of securities. The top-down approach differs in that it looks at more macro topics first, figures out, in a macro sense where the portfolio would want to be tilted, and then goes down and picks the securities that are tilted that direction. So what this means is the Master portfolio, being more of a bottom-up approach, it focuses first on finding attractive stocks by putting all sorts of screens in place, like PE, like profitability, like growth, and then it builds the portfolios based on that subset of stocks that it finds attractive. This is different from SSR that looks at size and style to try to figure out where the market is going, which style is in favor, and then fit companies into the pre-specified targets put in place. And this does lead to differences in performance. Given that the Master is more consistently tilted towards value, it's not surprising to us that it's actually outperformed since 2000, which is when the advent of the SSR portfolio or the SSR strategy came to be. There is such thing as a value premium, so the strategy that's most consistently tilted towards value, should outperform over the long run, or at least in theory. But recently, we've seen SSR outperform Master, and that makes sense given the flexibility afforded to SSR to tilt towards growth. The 2010s have been a decade dominated by growth outperformance, so we would expect SSR to outperform Master during this time frame. And this really leads to the final thing in terms of differences that is probably the most important to understand, and that's tracking error. The Master portfolio will carry more tracking error simply because it is almost always tilted towards value. Now, value is expected to outperform over the long run, but there will be long periods of time that it will underperform relative to the market, like today. In fact, there are lots of value strategies out there across the industry that are underperforming right now. And behaviorally, it can be very difficult to stick with a strategy that underperforms for a long period of time. Now, this is where it comes down to personal preference. So, you know yourself as a client, an investor will know what types of strategies that they are most likely to stick with. And for some people, they want to be tilted towards value because that's where the academic research suggests is the highest long-term return potential. But others find it difficult to stick through long periods of underperformance, even if they expect the strategy to ultimately win in the end. And for those types of investors, something with a little bit more flexibility can add value. Again, it comes down to the best strategy for you is the strategy that you can stick with. Now, in terms of our opinion, we're confident in both. But the thing that has been central to our mission for years is using research to find constant ways to improve our process. So Jack realized this in the 1970s and earlier when he found out that if he invested in value companies with growth potential, he was likely to create fruitful portfolios. SSR was born out of underperformance and research that suggested that you could play the size and style dynamic of the market and place certain bets based on what was outperforming. And we wanted to share a new tweak to our process that we believe is going to result in better stock selection. But before we get to that tweak, I want to first recap what our current stock selection model aims to do. The basic premise is that you can break a company down into factors, broad categories like value, growth, profitability, etc. And then you can find which of those factors are associated with long-term excess returns. What we aim to do is we aim to build models based on factors that work over the long term and emphasize the ones that are working best today. So companies with these factors should perform well over the long term. We do update this model every 6 months, and in fact, we're currently in that process now, so we hope to see new numbers online here in the next week or two. But another piece of this is we're looking to constantly add to our factor library. And right now, the factor library is at about 3,000 plus factors, and it grows all the time. And one of the things that's really come to prominence here recently is the concept of alternative data or big data. And that's where our relationship with a firm that is creating this type of data really comes to play. So the goal of AlphaDNA, which is the firm we're partnering with, is their whole goal is simply to predict companies that will surprise on revenue. The idea is that if a company beats analyst expectations, they'll typically see a positive boost to the share price. So how are they going about this? Well, consider that 90% of the data ever created has been produced in the last 2 years. There is all sorts of data online to sift through to find signal. And what their process is they go to search engines, social media pages, apps, and websites to look at the digital footprint left behind by consumers interacting with brands and companies. And what they try to measure is they try to get a sense for how much interaction a company is seeing versus how much interaction it typically sees, using machine learning algorithms to sift through the data and find the patterns. If there is more online engagement, the theory is that the company is more likely to beat on revenue than analysts are expecting. And through the years, their model has gotten very accurate. In fact, companies in the top tail of their ratings see revenue beats about 80 to 90% of the time, and their numbers have been improving. And these beats do translate to higher average returns. So given the nature that our signal uses traditional publicly available data to try to find companies that are sound long-term investments, and the AlphaDNA signal basically ignores fundamentals but looks to predict which companies are going to beat on revenue in the short run, there are some synergies between the two signals. We believe that they are complementary and improve each other's signal in a material way. Lowell mentioned in his introduction that there's a handful of tweaks that we roll out each decade that improve our process. And we believe that this is one of them here in the 2020s. We do have an extensive research graveyard, as I like to call it, of ideas that we thought should add value, but through testing were proven not to. And in fact, going back 20 plus years, we were originally interested in a similar type of signal. Using a machine learning technique called neural networks, we tried to predict which companies were likely to outperform. Now, there were probably a couple issues with that going back in the 90s. One, it's possible we were trying to solve too broad of a problem, and focusing on something more specific like revenue beats is better for machine learning techniques. But two, the computing power simply wasn't there, not anything like it is today. And you could probably also argue that the vast troves of data that we see out there today weren't available back then. So we were perhaps a little bit early moving on this. And I share that story just to highlight that we spent a long time trying to get neural networks to work, and we couldn't get them to work, so we ended up having to spike the project. And I wanted to share that we have a high bar to our process in adding new processes. We've been working with AlphaDNA for a handful of years, and we've been testing the signal pretty thoroughly over the last 2, including running live money. And we have come to the conclusion that we believe it can help our stock selection process. And while SCORE will always remain the backbone of that process, we believe that using their signal in conjunction with SCORE will help us with the timing of our buys and sells. It's an exciting opportunity, and we're excited to roll it out here in this quarter and moving forward. So before, as we approach the end of the webinar, Lowell has some closing thoughts for us.
Thank you, Andy. Thank you, Adam. We are excited about the utilization of this new signal. Pretty much all the trades that will occur ahead will have an influence as part of that. So, you know, and I guess I'll close on a general thought, and just as a sort of a reminder, stock markets are forward-looking. If you think about our list of worries that we covered earlier, you know, pandemic, economics, U.S. elections, and advance the clock 6 to 12 months, in all likelihood, most of those worries will be resolved and replaced, unfortunately, with a new list of worries, but it's the natural way of things. So, you know, I'd like to just close with, you know, stay safe. Let's look forward to a better 2021. And as my first boss and mentor here at the Burney Company, Ted Rosenberg, like to say, keep the faith. Thank you for joining us.